For more, we are joined by Jim Stening from FIIG Securities. Jim, good to see you. Happy New Year. Thanks for coming in. Just firstly, actually wanted to get a bit of information for you on how yields have been performing over the past week. What have you been seeing? Yeah,
well, as we're seeing sort of this recovery story feed through into the economy, we're starting to see rates move up. Some of the longer dated rates are starting to hit some technical levels, so the indications are that rates will continue to rise over the longer term.
All right, let's just have a look at what will be the major influences from your point of view on the bond market over the coming year.
Well, this year really the overarching story is of course global growth in the US and Europe, and whether or not that will continue. Interestingly, the IMF last night seems to be the opinion that growth prospects look better than they have done. So that's really the overarching theme. I mean, things do seem to be an emerging positive story seems to be coming out. So that'll be good. I think the other thing that we'll be watching closely is the inflation story. Obviously, there's two distinct camps. People who are completely not concerned about inflation, but obviously these things like energy prices and cost of living moving up is genuinely something that people will be very sensitive and nervous about going forward.
So how high do you think? Oh, sorry.
Well, yeah. Look, I think importantly in the short term, we're going to get an inflation figure at the end of this month. So that's going to be something that markets, particularly here in Australia, are going to be focusing completely on. I think that's going to set the tone for the first quarter.
What will that mean, do you think, then, for interest rates this year?
Well, I think interest rates will continue to move up, and I think probably, our view is that there is a little bit of pressure on inflation in Australia, so they'll probably move a bit further than people are indicating at this stage. I suppose the only problem with that is that interest rates or borrowing rates have moved independently of the official cash rate. So, we're sort of tipping at the moment that the official cash rate will get towards 5% towards the end of this year.
Just looking at what the Fed will do, because obviously we had those FOMC minutes out overnight, what do you think? I mean, because it certainly seems to be the consensus they're not going to be raising rates anytime soon.
No, that message is clear, and I think, you can sort of, you can bank on that almost. I think what seems to be emerging in their jawboning is that the things that they'll be looking at before they even turn their attention to the level of interest rates is the unwinding of these other stimulatory measures. So, buying of agency debt and government bonds, those sorts of things, they are coming to an end. So, I notice in the minutes that's something that they're debating and talking about. So once I think that those strategies are in place in terms of the removal of those, and in fact the removal of the purchasing programs and actually sale of those assets that they've bought, then they'll turn their mind to monetary policy. So I think monetary policy or adjustments to the federal the rate is some way off.
All right, let's just have a look at Australian debt markets, and where do you see opportunities this year?
Yeah, well, look, we've had a massive contraction in credit spreads. I don't see that credit spreads are going to move much further over the year. I think really this year will be a good year for purchases made in things like listed hybrids, unlisted hybrids and corporate bonds last year for people to take profits. But I also think that one of the things that's happened in our market and globally in particular is that liquidity is returning and sanity is prevailing. These markets are reopening, debt markets are reopening. So I think that what we will see in Australia, particularly over the last half of this year, is a developing high yield market. So we'll start to see these borrowers come to the debt capital markets to raise debt rather than going to banks, looking at alternative sources of funding. I think that's really encouraging because there's a growing group of investors, particularly self-managed super funds and high net worth investors who are looking for high yield. They're sophisticated investors and they can understand it.
What kind of difference in returns can you get, compared to the
Well, I guess if you look at the high yield index, which is a global index put out by Merrill Lynch, I mean, they're talking about 6.5% over benchmark as a rough guide, an average guide. Obviously there are outliers. There are very risky companies borrowing a lot higher and others borrowing lower levels. So those are attractive returns and very competitive with what's traditional equity returns. So something for people to consider.
Sounds like it's going to be another exciting year. Jim Stening, good to see you. Thank you so much.
Thanks, Brady.
Jim Stening there, Managing Director.